Welcome accounting boffins, you with Ashraf Patel. Accounting is the focus and we've got our crew with us. What are we doing today? Today we're looking at typical examination questions. Right, now before we actually go into the questions, let's take a look at this here. When you're dealing with your exams, remember paper 1 will always deal with your financial reporting and evaluation, okay? Whereas paper 2 deals with managerial accounting, internal auditing, control, etc. However, you're going to find that within your paper, you can get an overlap of these sections into paper 1 and into paper 2. So that's why keep in mind that yes, paper 1 deals with your financials, but it can also include ethical questions, interpretive data response questions, etc. Right? But remember, paper 1 is financial reporting and paper 2 is your cost and managerial accounting. Okay. So now, the financial year ends on the 31st of December 2020. Remember, we're doing an adjustment now. The rent income figure that's given to you in your trial balance is 126,224. Okay? The question now tells you that your rent was received up to January 2021. Take note that the rent was increased by 12% on the 1st of August 2020. Again, let me just give you an overview of the rentals and the types of adjustments that you can get. Firstly, the rental remains constant for the year. Either you've paid, if this was rent income, either you've received too much or you've received too little, right? So it can either be a deferred income where you receive too much of rental, or it could be an accrued income where you haven't received for the full 12 months. Right, those are the two possible adjustments with rent income, either deferred or accrued. Then, the types of adjustment. One is the adjustment, the rental stays constant for the year. You've received 1 month in advance, you just divide by 13, no problem. The second one is where the rental increased by a percentage, which is the one we're going to be dealing with just now. And the third one is where your rental increased and they give you the increase per month. Please make sure that you are in a position to calculate all three methods depending on which one is being examined. Right, the one that we're dealing with here is where the rental has increased as a percentage. So step number 1, what do? Take note of the following. It was increased by 12%. That's a percentage increase. And when was it increased? On the 1st of August. Right, so therefore, the most important thing here is let your old rental be 100%. Why do we do that? Because we don't know what was the rand value of the rental. What we do know is that the percentage of the old rental was 100%. That is why we make the old rental 100%. Okay, then, the next thing that you determine is for how many months was the rental at 100%. So obviously it would be January, February, March, April, May, June, and July. So these are the old months. And if you count, it's 1, 2, 3, 4, 5, 6, 7. So January to July is 7 months, as I've shown you there, right? Then the increase took place when? In August. Up to when? So very often you find candidates making this mistake. What is the error that they make? August, September, October, November, December, and they stop at December. But no, you've also received the rental for January. And that is why in the new rental you say from August to January. So in other words, your financial year here is January to December, correct? But because you've also received that rental, clearly that's the one out of your financial year. So you can see that the new rental would be from August to January, which would be 6 months, which will be your new rental. Okay, now watch my calculation here. 7 months old rental, watch what we do. We say fine, take that 7 times 100, which was the old, to give you a figure of 700. The new was 6 months, 6 times 112. Where did the 112 come from? Remember, old was 100 plus your new, the percentage increase for the new months was 12%. Therefore, the 112, if you multiply that by 6, gives you 672. So that becomes your new rental in terms of percentages. Now watch what we do, and this is important here. This is very important. We add the old plus the new to give us a figure of 1372 in terms of percentages, and that's what's important. Right, okay. And this is equal to what? In terms of my rental figure, if I pick up my rental figure again, 126,224. Here you can see 126,224. Clearly you can see here, that's the percentages and that's the rand value. Okay, now what are you trying to determine? What do you want to find from this calculation? You want to find out what was the January, which one? This one here. What was the rand figure of that January rental? Therefore, you say, because that January forms part of the new, it will therefore be part of the 112. 112, watch, important. Keep your percentages underneath one another, right? So that you don't mix up your calculation. The 112 is equal to my unknown. That's the x that I'm solving for. So watch. In my percentages, there's the 2 percentages underneath one another. There's my 2 rand values underneath one another. So now I cross multiply. 1372x, that's what I do. I cross multiply. 1372x, there we go, is equal to 126,224 times 112. Let's do that calculation there. And we say fine, 126,224 times the 112 divided by 1372, and that will give you 10,304. What is the 10,304, people? That is the rand value of the rental that you received in January. Right. Once you're done with the calculation, that's the first step. You've identified the correct amount for your adjustment. Now, how do you deal with the adjustment? And this is where it comes in now. Remember, deferred income tells you minus. Watch, that's the operation that I need. In my bracket, you start off with the 126,224, which is your given figure, and then the operation tells you minus 10,304 to give you your final figure of 115,920. So this is how it will appear in your statement of comprehensive income. However, in terms of my balance sheet, watch, where does deferred income feature? It features in my trade and other payables, right? Under the item deferred income, I have the figure 10,304. Okay, so this is important. In this particular scenario, you're looking at the impact on the statement of comprehensive income, as you've seen there. There we go. And you're looking at the impact on the balance sheet, namely the statement of financial position. Remember the new names that are being used, so we'll use them interchangeably. Statement of comprehensive income, income statement. Balance sheet, statement of financial position. Okay, so here it goes under trade and other payables, deferred income, 10,304. Another important aspect of this here is when you are doing your adjustments, the first thing that you do is you go to your balance sheet account section to see whether any of the big 5 appear under my balance sheet account section. What am I referring to here? Right? The accrued income, deferred income, accrued expense, prepaid expense, and consumable stores on hand. If they do not appear, you now can continue with your adjustments knowing that the reversals have been done. If they do appear, then you have to take the reversal into account when you are completing your adjustment. Very, very, very important. Okay. The next adjustment says here, your financial year end is the 31st of December 2019. Salaries and wages was that figure. Employer contributions, 85,000. So in this particular example that you see in front of you, you find that your salaries and wages is a standalone expense and your employer's contribution is another expense, also standalone. At this juncture, allow me to also explain that sometimes these are combined. So where you don't find them as two standalone expenses, then you are expected to treat them all as one expense under the umbrella of salaries and wages. Okay, let's look at the example. It says here, your net salary was 92,000, your deductions was 29,000, and your employer contribution was 19,800. Okay, so in terms of my income statement, I start off with my 575,000 given to me, right? There's the 575,000. Watch. Where does the 121,000 come from? And that's the important part. Watch here. If you take your net salary to be 92,000, right? Plus your deductions of 29,000, that will give you a figure of 121,000. So what have we done? We're adding the net salary plus my deductions to give me what we want here as our total salaries now will be 696,000. So that 121,000 is your net salary plus your deductions. Now watch, your employer's contribution was the 85,000. Again, your 85,000 coming from your employer contributions. Here we go. 85,000 was a given figure in my trial balance. So I start off with the 85,000, right? Plus the 19,800 to give me a figure of 104,800. Okay, the next one. And this is important now, guys. What's the impact of that adjustment on my balance sheet? Here goes. You have your net salary as part of creditors for salaries, right? You have your SARS, PAYE, and you have your pension fund. So in other words, what you notice from this year is that you're debiting salaries, you're debiting employer contributions. That's an impact on your income statement, but the credit entries are impacting on your balance sheet, where under trade and other payables, you have all your adjustments in respect of salaries and wages, creditors for salaries, SARS, PAYE, pension fund, etc., medical aid, whatever you have. But in this case here, these are your liabilities. And remember, these are amounts that you owe. Remember, these are amounts that you owe to your creditors. Right. The next one we have here is write off a further bad debt of 5,000 Rand and then adjust the provision to 10,480. So what do we do here? We start off by saying, in my bad debts, start off with my given figure of 9,750, add the 5,000 to it to give me 14,750. This is my bad debts adjustment. Okay, now if I look at my provision for bad debts, firstly, I have a provision of 14,000 Rand. You do remember that provision for bad debts is a negative asset. What do we mean by that? By that we mean it reduces the value of your asset. Which asset? Debtors control. Therefore, debtors control less provision for bad debts will give you net trade debtors. Okay, and you're going to see that when we're doing the balance sheet. So if we're adjusting our provision now to 10,480, they're telling us that in my provision, I had 14,000, I must reduce it to 10,480. That means I must reduce my provision by 2,570. This then tells me that when I reduce my provision, it becomes an income as an item called provision for bad debts adjustment. Remember, that is your nominal account. If I had to increase my provision, then my provision for bad debts adjustment would appear under operating expenses. Okay, so there we go. Now look at your balance sheet. Here we go. Remember what we said? There's my trade debtors, 350 minus the 5,000 first to give me my 345. Then we said provision for bad debts. It's my new provision. Remember, 10,480. So this clearly indicates to you that provision for bad debts is a negative asset. It reduces the value of your asset. Which asset? Debtors control. Look at it. You've got 345,000 as your debtors control, less your provision of 10,480 to give you net trade debtors of 334,520. So in this case here, you can clearly see how that adjustment impacts on both your statement of comprehensive income. What will go in there? The adjustment of your provision for bad debts, either the increase or the decrease. And what goes to your balance sheet? Your final amount, your new provision that you need in your balance sheet is the 10,480. There we go. There it is. And this then completes the adjustment. Okay. Okay, guys. The next adjustment we're looking at is the adjustment on the loans. Remember, this is your loan figure that's given to you, 1,725,500. What else are you told? You are told that you have fixed monthly repayments, including interest, to be 31,600. But remember, it's monthly, okay? And they're telling you that the capitalized interest amounted to 242,500 for the year ended 29th of February. Interest for the next financial year is expected to be 162,000. Part of the loan will be repaid within the next financial year. Right, so now, what do we know? Look at our loan account. I always ask learners to draw up the loan account so that you can see, put in the information, and then it becomes much easier to complete your balance sheet. Here goes. Your opening balance, 1,725,500. There's your bank, 379,200. Remember, what was it? It was the 31,600. 31,600 times 12 will give you 379,200. There's the 379,200. Okay, the interest was 242,500, given figure. So your closing balance is 1,588,800. However, now watch this here. Here's my loan as it should appear in my balance sheet. I start off with my opening balance minus my repayments plus my interest. Now, you were told something very important here. Interest for the next financial year is expected to be 162,000. Right, so this is what we're going to now do. Watch this here. We're going to take the figure of the payment. Where's the payment? Here we go. Of 379,200. Right? We've got the 379 minus the 162,000 which we were told. Let's identify that figure first. 162,000, right? Let's take the 162,000, 162,000, and there we go. No, that's wrong. Let's get the figure right. 162, 123. That will give you a figure of 217,200. Can you see? That's where we're getting the 217,200 from. That is the portion of your short-term loan. In other words, you're expecting to pay a certain amount next year. So what do? You take last year's capital repayment, the total figure, the bank figure, the 379,200, minus the interest you expected to pay to find out what will be your capital repayment. Okay, guys, that's it for the adjustments. Let's take a quick break. When we come back, we'll start with a new question. See you just now.